we are live.
ಎಲ್ರಿಗೂ ನಮಸ್ಕಾರ. Hearty welcome to Jnanarjane Empowering Excellence Study Circle on the topic Finance Bill to Finance Act. There are major changes, it seems, more than 100 changes from bill to act. To enlighten us, we are really fortunate, an expert, an eminent speaker, CA Naveen Khariwal is with us. He's going to impart his knowledge with all of us on Finance Bill to Act. So on behalf of Bangalore branch and on behalf of all the participants here, wholehearted welcome to CA Naveen Khariwal. Hearty welcome to you, Mr. Naveen. Friends,
Thank you very much.
You are welcome, CA Naveen. So friends, he is going to enlighten us on the topic. I'll take a few minutes of yours regarding the upcoming programs of Bangalore branch. Tomorrow, day after tomorrow, Friday, we are going to have a session on charitable trusts and institutions. There are major amendments in that. I think all of us need to renew all the 12A and 80G registered trusts and all the institutions, renew their registration. That I think has to happen before 30th June. I think current deadline, it may get extended, but it is advisable to learn that and act on that. So in that regard, we organized that program. Dr. CA Suresh N is going to enlighten us on that topic. It is going to be a 3-hour session, Friday morning, 7th Friday morning, 10 to 1. It is the program. Please register yourself and attend that program so that you can learn how you have to handle your trust and society clients, those who are registered under Section 12A. Then on 15th Saturday 15th May, we are organized a program on networking and corporate form of practice. ICAI has come out with the new networking guidelines. To enlighten us on that networking new guidelines of the ICAI, we have invited our Central Council member Dayanima Sharma. He's joining from Hyderabad, and he's going to impart the details of new networking guidelines to all of us. It is going to be a free 2-hour CPE session from 6 to 8. The registration link is opened in the ICAI website. Please visit bangaloreici.org and register for that program. So networking is the need of the hour. So each of us need to network and make a bigger firm, and so that we can give all kind of service to our clients in this technology age. So it is easy to network and do multiple jobs across India, even abroad. So in that regard, I think ICAI has come out with that new networking guidelines. Multidisciplinary practice also possible under new guidelines. In that regard, CA Dayani was going to share all the knowledge, all the new guidelines about the details to all of us. Please look into that and register. It's a free program. You are going to get 2 hours CPE also. Then from 24th, 25th and 31st and 1st, we are organizing a wealth management workshop. It is going to be a 4 days workshop, 3 hours each, evening 5 to 8. From 24th May, 4 days workshop on wealth management. Please register. It is a lucrative area to those who are interested to take up new areas of practice. Please look into, again, bangaloreici.org and register to that program. In addition to that, the current income tax workshop for 18 days is the first module is over. The remaining 5 modules are open for registration. It is going to start tomorrow. Please look into that. If you are already not registered, please register for the remaining modules. Even 1 or 2 also is possible to register, or all the 5 also you can register. So I request you to look into that so that you can learn a lot. So in this pandemic, things are really difficult to all of us. There are so many problems with the near and dear one. Still, I think we need to continue this. Otherwise, we may go into depression because of the problems and the scary things around us. At least concentrate on this for few hours and equip yourself to face the new challenges. So otherwise, we have to be at home only. I sincerely advise all our members to take care, be safe, and be at home, not to venture into unless it is really required to go out. Protect yourself with the mask and the sanitization, all other COVID precautions, each one of us to need take. There is no other way, because if more and more numbers get affected, the facility is not enough. We cannot blame anyone. No country or no one is able to provide for all their citizens the hospital facility. Currently the pandemic is taking every day 25,000, 30,000 cases, means even 1%, 2% also means 300, 500 people require hospital facilities. That is impossible. Even country like advanced countries like Europe and America also found it difficult to meet their students requirement. No, sorry, their patients requirement. So in that regard, we cannot expect anything from the government. We have to take care ourselves. Don't venture into those who are affected. Please stay away from the others. Don't spread it. That is the only thing we can tell for our members and the citizens around us. That is the only thing. We cannot blame anybody, or even if you have any influence also, when the things are not available at all, it is very difficult to meet the requirements. That is how the situation in that regard. But still we are continuing these learning sessions with that idea. Many people are also telling that why you are continuing, but I thought this is the thing, at least we can keep occupied. Otherwise many people are not even, don't have any work at home. They are not well connected in their systems of the from their office. That is the reason many people don't have any work. So at least they can learn something, equip themselves to face the new challenges. In that regard, Bangalore branch is continuing these study circles, workshops, and many more activities. I hope you people appreciate these things. With that note, I once again wholehearted welcome to all the participants. So learn and enjoy the learning. With that note, once again, hearty welcome to Naveen Khariwal. Over to Divya.
Thank you, Chairman. A very pleasant good evening and hearty welcome to each one of the participants and to our speaker. I would like to give a brief introduction about our speaker of the day, CA Naveen Khariwal ji. Comes from a family of chartered accountants, specialized in direct taxes, corporate member of Direct Taxes Committee of ICA New Delhi for the year 2020-21. Also member of Central Taxes, Corporate Laws and GST Committee of Federation of Karnataka Chamber of Commerce and Industry, Bangalore. He is a member in Finance Advisory Committee of Karnataka State Cricket Association, Bangalore. He is also member of Study Circle of Committee of Chamber of Tax Consultants, Mumbai, and part of team nominated by Bangalore Bench of SIRC of ICA to represent before Honorable Justice E. Ishwar Committee for Simplification of Taxes. He is also speaker at many seminars and study circles organized by various branches of Institute of Chartered Accountants of India. He's a cricketer having represented college and university matches and played in league registered with Karnataka State Cricket Association and represented in cricket matches organized by Bangalore branch. With this very brief introduction, I welcome you for today's study circle, sir. Over to you, sir.
Thanks, Divya, for a kind introduction. Before commencing my session, I would like to strongly advocate and support my chairman. He's doing a great job in the limited time since he has taken over. If you see already, I think two most outstanding sessions, according to me, in my personal opinion, was the chairman gave time and gave two sessions to our senior chartered accountants who recently passed away, namely as Krishna Swami and late Sri H.A.K. Rao. So that touched me really, and the institute had time for all our seniors. They gave outstanding tributes to these outstanding personalities. And one more session, which our chairman is currently, it is being telecast. Is the direct tax workshop. where they revisit Income Tax Act, spread over 18 days, having 84 hours and 40, I'm telling you, my dear friends, professional colleagues, 40 speakers all over India. So nothing better than this. And as he has rightly told, let us, not test positive, but be positive in our thoughts, as he has told. Let us, stay positive and let us not test positive, but be positive in our thoughts and utilize this time. Because I just spoke to my close friend, Dr. H.V. Madhusudan of Trustwell, the best, neurosurgeon in Bangalore. He told me, don't worry, it is going to show a dip. The curve will dip probably in the fag end of May, as my chairman also was telling. He told, don't worry, it is going to dip. Based on their research, this is what he had to tell me. And anyway, we'll have to wait and watch. So the situation is all the same throughout the entire country, but Bangalore is hard hit now. Anyway, so let me start the presentation. Yeah. So as the chairman was also telling, more than 100 amendments in this Finance Act, when it became from bill to act, March 23rd, this finance bill became an act and it got the assent of the President of India on the 28th March. On 23rd, it was passed by the Lok Sabha, and on 28th, it got the assent of the President of India. Now, between the bill and between the act, the government so fast, whatever suggestions, 1st February, Madam Nirmala Sitharaman came and, shared the budget. First paperless budget all over India in the 70 years of independence. First paperless budget. And then you see on that very day, there was an app introduced and everything was coming in the app itself, live updates. Secondly, you see the government is so fast listening to people. Between 1st of February and between the day it was passed, 100 amendments are made, like the chairman has told. But don't worry, out of 100 amendments, most of them are all, what I call as grammatical errors, some insertion, some deletion of words, and also 10 new sections introduced. So basically 127 amendments are made to the finance bill and then it is passed. But not to worry, most of it are all grammatical errors, some insertions, some amendments, some deletions, etc. But for that, there are 10 new sections introduced also. We have ample time to go through all the important provisions of the Act. So now, let me just start the presentation. So as you know, my dear friends, there are no changes in rates of taxation. It is all one and the same as compared to the last year. That is your assessment year, financial year 1920, which will also continue for financial year 2021. Then individual and HUF taxpayers, they have an option to opt for taxation under 115 BAC. My humble request to all the practicing chartered accountants, please prepare 2 statement of total income. When you prepare the, this return of income, statement of total income for this year, please prepare 2 statement of total income. One that is only for individual and HUF. One is you opt for 115 BAC and one you opt for the normal rates of tax and normal regime. 115 BAC as well as, because you never know which is more beneficial. Prepare 2 statement of total income and then, automatically you can decide whichever is more beneficial to the SSE. There is nothing to worry. You can opt in and opt out year on year. So that is only for individual and HUF basically. Now, so as I told you, the rates are all same. There are no changes. Resident individual below 60 years, up to 2.5 nil, between 2.5 to 5 lakhs, 5%. And as the income exceeds 5 lakhs, but less than 10 lakhs, it is 20%. So here, I thought the government, they could have tweaked here, the finance minister, because moment it goes beyond 5 lakhs, the tax rate rises sharply to 20%, as against, 5% below, below when the income is below 5 lakhs. So between 5 lakhs to 10 lakhs, it is 20%. And then,
So your voice is not coming, Mr. Khariwal.
yeah. Am I audible, sir?
Yeah. Now you are.
Yeah. So where the total income does not exceed 3 lakhs, it is nil. Then it between 3 lakhs to 5 lakhs, it is 5%. And then 5 lakhs, but does not exceed 10 lakhs, it is 20%. Above 10 lakhs, it is 30%. And for a resident individual above 80 years, up to 5 lakhs, it is nil. And then the slab rates continue. So 115 BSE, I told you, those conditions, no exemption, no deduction, no claim of set off of loss. So individual or HUF, you can exercise the option year on year. You can, what are the rates of tax? Less than 2.5 lakhs, 0%, next 2.5 lakhs, 5%, next 2.5 lakhs, 10%, next 2.5 lakhs, 15%, next 2.5 lakhs, 20%, next 2.5 lakhs, 25%, and greater than 15 lakhs, it is 30%. Now, what about surcharge? Yeah. So here they say having a total income exceeding 50 lakhs, but not exceeding 1 crore, it will be 10%, including your 111A and 112A in the total income. Again, total income including 111A and 112A, your short-term and long-term capital gain exceeding 1 crore, but not exceeding 2 crores, it would be 15%. Then having a total income excluding the income under the provisions of 111 and 112A exceeding 2 crores and between 5 crores, it would be 25% of income tax. Similarly, having a total income under the provisions of excluding under provisions of 111 and 112A exceeding 5 crores at the rate of 37%. And again, having a total income exceeding 2 crores now, including your short term and long term, but not covered by the earlier slabs, that is C and D, it is only 15%. Then there is a very good, amendment here. I mean, the total income includes any income charged by 111 and 112A. Then the rate of surcharge shall not exceed 15%. So nothing to worry. Now, continuing, 87A is the rebate, 12,500 or income tax, whichever is less, if the total income does not exceed 5 lakhs. Cooperative society, no change. Surcharge, education cess, no change. Firm, as usual, 30%. Surcharge, 12% of tax where total income exceeds 1 crore. Education cess is 4%. One beautiful amendment is made. 45.4 is substituted by new 45.4. What happened was, in the earlier finance bill, 45.4, 45.4A, 48 clause 3 were inserted in case of all partnership firms, AOP, BY. Okay. Now what has happened? New 45.4 substituted, 45.4A removed from in the act, and 48.3. So very interesting provisions. We'll spend some time there discussing those provisions. And mind you, those are applicable from this assessment year itself. So what all, tax planning was done, you go back to your drawing table, all strategies to be reworked, whatever you had done, thinking that let me do planning. On the day madam came and announced the budget, discussed the provisions of the act 1st February. On the day itself, it is applicable, my dear friends. Provisions of 9B, read with 45.4, read with 48.3, read with 45.1 are applicable from this assessment year itself. Although it has come on 1st of February, therefore even advanced tax planning, my dear friends, you would have planned in such a way the exit of the partners, the exit of the partners and the whatever money you would have paid them, whatever capital asset you would have given them, whatever stock in trade you have given them will now suffer tax and you have to pay advance tax. Shortfall in advance tax will attract 234, B and C as the case may be. The tax planning, the loophole is plugged on the day madam presented the budget itself from that very assessment year. Anyway, so domestic company, there are 4 rates, all of you know. If the total turnover or gross receipts of the previous year 18-19 does not exceed 400 crores for this assessment year, when you compare the turnover of financial year 18-19. If it does not exceed 400 crores, it is just 25%. In any other case, that means turnover is more than 400 crores, it is 30%. Apart from it, there are 2 more rates. Surcharge is 7% where income exceeds 1 crore and 12% where total income exceeds 10 crores. However, earlier there were 2 sections inserted, 115 BAA, 115 BAB. BAA is, for your manufacturing companies, BAB other than manufacturing companies. Yeah, BAB is for manufacturing and BAA is other than manufacturing. So 22% there and here only 15%. What more you want? And surcharge in both the case would be 10%, along with health and education cess of 4%. Now, foreign company rates are unchanged. Tax rate is 40%. And surcharge is 2% where the total income exceeds 1 crore and 5% where total income exceeds 10 crore along with health and education cess. Now, liable to tax rephrased. So this liable to tax was also there in the bill. But now what has happened, my dear friends, at the time of passing the act? What was there in originally the finance bill? What was it? Liable to tax, 229A. It provided that liable to tax in relation to a person meant that there is a liability to tax on such person. It was worded like this: liable to tax on such person. Which liability? It may be income tax liability. It may be another liability under any other act. So therefore, now that is changed. Now, what was earlier? Liable to tax. They did not specify it is income tax, or they did not specify under which act. In relation to a person means that there is a liability of tax on such person. Again, it continues in the same fashion in the bill. Liability of tax on such person under any law for the time being in force in any country, and shall include a case where subsequent to imposition of tax liability an exemption has been provided. Now, see, immediately the government is so proactive. It is immediately changed the definition now. What words they have removed here? It did not specify the nature of tax. So therefore, in the absence of specific reference to income tax, it could be concluded that if a person is paying any tax, he must be regarded as liable to tax in such country. So now what are they telling? This ambiguity was removed by the bill passed in Lok Sabha. So what is the new definition now? Liable to tax in relation to a person and with reference to a country. They have added this: with reference to a country in relation to a person means there is an income tax liability. Now the word income tax, now it has come, it precedes the word liability on such person under the law of that country for the time being in force, and shall include a person who has subsequently been exempted from such liability under the law of that country. Therefore, two changes have been made. What are the changes as compared to the bill? First is liability with reference to a country, and second, there should be an income tax liability. So that is the amendment made in 229A. Now, what is the next amendment? See, with the exemptions, this PF and RPF. Exemption of interest received on employees' contribution to PF and RPF. This is applicable from assessment year 22-23 onwards. So all of you know, 10-11 interest from PPF exempt any amount. 10-12, interest from RPF exempt. Entire interest accrued received on employees' contribution exempt from tax without any threshold limit. Therefore, what many of them are doing, many employees are contributing huge amounts under employees' contribution as there is no cap on the same. But ATC is only 1.5 lakhs. Don't worry about that. ATC is 1.5 lakhs only. But here what is happening? This is a very good retirement plan. Before this, up to this budget, it was a very good retirement plan. Who is going to give you 8% interest post-retirement, taken care of? 8% exempt, fully exempt interest. So therefore, what people were doing, for example, Lalit is there, my good friend, chartered accountant. He has got other sources of income also, like your capital gains, like your salary and like house property, etc. They are not bothered. So they are taking huge amounts, 10 lakhs, 20 lakhs, depositing in the PF and getting huge interest. So there is no limit there here. Obviously, ATC limit is only 1.5 lakhs, your PPF, etc. But here PF, now they are not bothered. So they are depositing huge amounts, RPF, etc. and claiming interest. So now the government came, now they are telling, sorry. What is the reason? The government is telling here, if you see, the government is telling 4.5 crore contributors as of today under EPF, out of which 1.23 lakh accounts are of HNIs who contribute monthly very huge sums to their EPF account. Their total contribution is itself to the tune of 62,500 crore. And as of today, the government is paying interest, assured interest at 8% with all tax exemption to the very high category income, persons at the cost of honest, low, middle class salary taxpayers and other taxpayers. So therefore, now they have brought in an amendment. What are they telling? I am sorry. Now, employees' contribution, you contribute 10 lakhs, 20 lakhs, 30 lakhs, but up to 2.5 lakhs only. What is the contribution? Interest. I will take it as exempt. It relates to the amount or aggregate of amount of contribution made by the person exceeding 2.5 lakhs, then it would be taxable. So employees' contribution up to 2.5 lakhs, interest earned on the 2.5 lakhs will be exempt. Now from which date? Obviously 1st of February. Whatever earlier contributed continues to be exempt, don't worry. From 1st of February onwards, your contribution, employees' contribution, 2.5 lakhs, don't worry, up to 2.5 lakhs, interest is free. If you contribute more than 2.5 lakhs. For example, you contributed 10 lakhs. Then on that 7.5 lakhs, whatever interest you are going to earn would be taxable. Next, this Finance Bill Lok Sabha also added a second proviso. That was the first proviso to 1011 and 1012, limiting to 2.5 lakhs. Employees contribution 2.5 lakhs. Up to that, interest earned on that employees contribution up to 2.5 lakhs will be exempt. Beyond 2.5 lakhs, it will be taxable. Now, second proviso is added to 1011 and 1012. They are telling if an employee is contributing to the fund, but there is no contribution to such fund by employer, automatically they are telling the interest income accrued during the previous year, taxable to the extent relates to contribution made by that employee to that fund in excess of 5 lakhs. So that limit of 2.5 lakhs will now become 5 lakhs. Because why? Employer is not contributing. If only employee is contributing, then they tell, okay, up to 5 lakhs, you need not worry. Whatever interest you earn on your contribution up to 5 lakhs, it is exempt. Beyond 5 lakhs, it would be taxable. That is the amendment made in this Finance Bill Lok Sabha. Now, my good friend Shravan, I was just discussing with me. He called me yesterday. He told me, sir, why wouldn't, as per the rules of PF, why wouldn't employer contribute? Employer has to contribute an equal amount as per employee. So that was the question he had raised. How come when employee is contributing, employer also should contribute an equal sum? So, but here, what is envisaged here is telling, amendment is only telling that suppose employee is contributing to the fund, but there is no such contribution of such fund by the employer, then the interest accrued will extend. The limit would extend up to 5 lakhs. And beyond 5 lakhs only, whatever interest income is earned would become taxable. Now, it would be taxed under which head, sir? Obviously, under the income from other sources, because such income should be taxable as residuary income, as it not accruing from a source emanating from an employer-employee relationship, and then no special rate for taxability of this interest, normal rate. Further, there would be a TDS component also. Who will deduct TDS? Under 194A by those PF authorities, EPFO. Obviously, PF authorities. Next, LTC scheme 10.5, 21-22. So, because of COVID, the employees' travel was restricted. Even the family members of the employees' travel was restricted. He could not proceed on leave to any place in India because of COVID. So, therefore, you don't spend that leave encashment 10.5, leave your LTC cash scheme. It becomes taxable. Because of COVID outbreak, he could not travel. So, therefore, they are telling, don't worry. I am going to give you a tax exemption for the cash allowance in lieu of LTC, subject to fulfillment of certain conditions. So what are the conditions you have to fulfill? You spend that LTC on specified expenditure. What is that specified expenditure? What is the block period now for LTC? It is 18 to 21. Now you have to spend that expenditure, he says, whatever LTC is there, spend it on what? Specified expenditure. What do you mean by specified expenditure? You have to incur on yourself or member of your family during the specified period. What is the specified period, my dear friends? It is between 12/10/20 to 31st of March 21. Please spend during this period on what? On all goods or services which are liable to GST. You spend on all goods or services which are liable to GST at an aggregate rate of 12% or above under the GST laws, and the goods are purchased or services are procured from all GST registered vendors or service providers. And that too, you have to spend only in account paycheck drawn on a bank. And you have to collect a receipt from those GST vendors and service providers, collect a receipt. Now, what is the amount of exemption? It shall not exceed 36,000 per person or 1/3 of specified expenditure, whichever is less. So 36,000 means at least you have to spend 1,08,000. Then only it becomes 1/3. Now, moving forward, unit linked insurance scheme, ULIP. What is this, sir? Now ULIP, it was always there. 1010D. 1010D exemption received for some under LIC, including some allocated by way of bonus. It is exempt. Provided what? During the term of the policy, the premium payable does not exceed 10% of actual sum assured in any of the years when the policy is still there. Now, on or after 1st April 12, and it was 20% in case of policies on or after 1st April 2003. So, you know this. So, life insurance policy proceeds on maturity, they are not taxable. And also received on the death of the policyholder is treated as exempt. Now, these provisions are equally applicable to ULIP. What is a ULIP? ULIP is also insurance policy along with the investment component, having an investment component. Now, again, they are why this is done. This is amendment is made to plug one more loophole. They are telling there is no limit. You know, Lalit is paying 10 lakhs, 20 lakhs, 30 lakhs and claiming exemption on the proceeds of maturity of life insurance policy, ULIP. So now they are telling, I am sorry, now what I am putting a cap on the annual premium. What is the cap now? They have inserted first explanation 3, telling what? Defining ULIP. What is a ULIP? I told you it has a component of both investment and insurance and is linked to a unit as defined in Regulation 3 of the ULIP Regulations Act, Rules 2019. Now, they have inserted 4th proviso, 5th proviso, 6th proviso, 7th proviso. What is 4th proviso? You are telling, my dear friends, after 1st of February, premium payable for the previous year cannot exceed 2.5 lakhs. Premium payable cannot exceed 2.5 lakhs. Here also they are putting a limit. So that is 4th proviso. So what happened? The client went to Lalit here. He is a sharp chartered accountant. Don't worry. We will make 5 policies. You make 2 lakhs, 2 lakhs, 2 lakhs, 2 lakhs. So in order to tackle such, intelligent chartered accountants, they are telling, please, I am inserting 5th proviso where the premium is payable for more than one ULIP on or after 1st of February. Aggregate premium does not exceed 2.5 lakhs for any of the previous year during the term of the policy. So that is also plugged. That loophole is also plugged. Then 6th proviso. What is 6th proviso? They are telling provisions of 4th and 5th proviso shall not apply to the death of the amount received on the death of a person. Fair enough. It is exempt. So 4th proviso is what? You pay more than 2.5 lakhs. 5th proviso is what? You pay more than 2.5 lakhs in aggregate of all policies. So 6th proviso is 4th and 5th proviso will not apply even though there is a violation if the amount received on death of a person. Then what about, the 7th proviso? Insert 7th proviso to this clause to enable CBDT to issue guidelines with approval of central government. Then they are telling, I am providing a proviso telling what? ULIP to which the 4th and 5th proviso applies. That means what? Premium paid more than 2.5 lakhs, aggregate of premium paid more than 2.5 lakhs. It becomes a capital asset. Why? See, whatever proceeds you are receiving, it is not taxable. So now they are telling, if there is a violation of 4th proviso or 5th proviso, automatically this ULIP will become a capital asset under 214. So therefore, they have inserted a new provision under 45(1)(b). So what is that 45(1)(b)? 45(1)(b), they have inserted a new policy telling that wherever there is a violation of 4th and 5th proviso, that means what? It becomes a capital asset and you have to pay capital gain tax, 45(1)(b). Now, how to pay capital gain tax? They are telling it will be this ULIP. I make an amendment in definition of equity oriented fund. Equity oriented fund means 112A. So therefore, there is no indexation and that limit of 1 lakh will also apply. So beyond 1 lakh, you pay the tax. Very simple. 112A, 45(1)(b), no indexation. Based on the period of holding, 111A, 112A will be there. STT is also made applicable. Next. Now, that was the 2021 Finance Act amendment was done. Now again in the bill, Lok Sabha, one small amendment is made in this section. What was it? Now Finance Bill Lok Sabha has inserted a second proviso to 112A, stating that the minimum requirement of 90% or 65%, as the case may be, is required to be satisfied throughout the term of such insurance policy. Meaning what? What was the earlier amendment and what is the amendment in Finance Bill? Earlier amendment was what? Such fund invests minimum 90% in case of investment in other units listed on a recognized stock exchange, or 65% in any other case in equity shares of a domestic company. Now, the amendment made in this bill is what? That minimum requirement of 90% or 65% is required to be satisfied throughout the term of such insurance policy. Next, these are two more sections inserted in the Finance Bill Lok Sabha. Now, Madam Nirmala Sitharaman, she laid a lot of emphasis on long-term debt financing on infrastructure. So she always wanted to say, wanted a professionally managed developmental financing institution, DFI. So for that it is provided now 2 sections to act as a provider, enabler, catalyst for infrastructure financing. So accordingly, she introduced a DFI. What is a DFI? It is an institution promoted by Government of India basically to provide development finance to one or more sectors or subsectors in the economy. The basic emphasis of DFI is on long-term finance and on assistance for activities or sectors of economy where the risks may be higher than the ordinary financial system is willing to bear. So two clauses are introduced, 10 within bracket 48D, 10 within bracket 48E. So what is 1048D? 1048D has been inserted to grant exemption for any income accruing or arising to an institution established for financing the infrastructure and development. Now, this institution shall be set up under an act of parliament, which would be notified by the central government. What is the quantum of exemption? What period quantum of exemption is available? Exemption is available for a period of 10 consecutive assessment years, beginning from the year in which the institution is set up. Now, what about 1048E? It is inserted to provide exemption to any income which is accruing or arising to a DFI licensed by RBI. What is the period of exemption? Available for 5 consecutive assessment years, beginning from the assessment year, same, relevant to previous year in which DFI is set up. However, they say the central government can extend the period of exemption for a further period of not exceeding 5 more assessment years, subject to fulfillment of conditions as may be prescribed. Next, your charitable institutions and trusts. So what are the amendments? You take 1023C 3AD, 1023C 3AE. There are 2 sections. What are those, my dear friends? You know, all of you. 1023C 3AD applies to university or educational institution, and 1023C 3AE, it applies to your hospital or other institutions. So where the annual limit was prescribed, it was only 1 crore. So for this, there is no need to fill any condition. You have to just file the return of income. No 15%, no, all that, nothing is there. Just you have to, no application, etc. You have to fill ITR 7, claim the exemption. So what was the limit? It was 1 crore as per Rule 2BC. So what happened? Representations have been received to increase this limit of 1 crore as provided under section Rule 2BC. So therefore, in order to provide benefit to all small trust and institution, amendment is made 1023C 3AD and 3AE. The limit is increased to 5 crores. And such limit shall be applicable for an assessee with respect to aggregate receipts from universities or educational institution or institutions as well as from hospitals. This is mainly done, why this is done? It is done to revoke the judgment of Karnataka High Court to overcome the decision of Karnataka High Court judgment 34taxman.com Children's Education Society, where what was it? Assessees having more than 1 educational institution, then aggregate annual receipt of each of such educational institution had to be considered separately. Suppose if a trust is running 5 educational institution, then each of such institution will enjoy that 1 crore limit. So therefore, now they are telling nothing doing. For example, RK group of institutions, they have got 5 hospitals. That means what are they telling? Total receipts of 5 hospitals should be not more than 5 crores. Or take, they have got 10 institutions, 5 hospitals, 5 educational institutions. So 10 institutions together, it will not be beyond, 5 crores. Earlier, I could take 1 crore each. So therefore, 10 crores. So that judgment of Karnataka High Court is now nullified. Next. Now they have made some more amendments, why? To eliminate the possibility of double deduction while calculating application or accumulation. Now what was happening, corpus donation, now they are exempt. Existing provision, corpus donation are exempt under 3rd proviso to 10 within bracket 23C as well as 11(1)D. Voluntary contribution made with a specified direction, they shall form part of corpus of the trust, are exempt. That is, they do not enter the statement of total income. Now, why this is done? Instances have come to the notice where these entities claim the corpus donation to be exempt and at the same time claim their application as part of mandatory 85% application from income other than the corpus. This results in a situation where the corpus income has been exempted and its application has been claimed as application against the mandatory 85% application of non-corpus income. Now, there is A trust and there is B trust. So A trust is giving corpus donation to B trust. A trust is claiming it as application. Naturally, you are giving corpus donation, you claim as application. B trust is receiving corpus donation. 11(1)D, it is telling it is exempt. Why should I spend karke? Because corpus donation are exempt. donations, voluntary donations with a specific direction that it shall form part of corpus of the trust. 11(1)(d), the recipient will claim exempt and the donor, the charitable trust, will also claim exempt. So therefore they are telling this corpus, that A, B will give to C, C will give to D. So circuitous route, D, corpus. So both of them are enjoying. Now they are telling not possible. If you give corpus, I will not allow as application here. Why? Because that fellow is recipient is already claiming exempt. So no question for you. I am not going to allow the deduction to A. Again, what are they telling? Instances have also come to the notice where these entities take loans or borrowings and make application for charitable religious purposes out of proceeds of loans and borrowings. Such loans or borrowings, when repaid, are again claimed as application. Now, my dear friend, there is RK Charitable Trust. It wants to buy a property. Cost of the property is 10 crores. RK Charitable Trust has got 5 crores in their corpus fund, or they have got in their bank account or investment. 5 crores they have got with them in their bank account. 5 crores they took loan. So what were we doing? Chartered accountants, we are telling, accounting. Loan, 5 crores shown as liability, 10 crores shown as asset in balance sheet. At the time when I purchased the building, I claim entire 10 crores as application. At the time of repayment of 5 crores, I again claim as application. So now they are telling we don't understand accountancy. Don't discuss about this accountancy. It is only income tax law. When have you repaid? At the time when you purchase the property, I will not allow as application. I will only allow as application as repayment of loan along with interest. No doubt about it. I will allow this application only at the time of repayment of loan along with interest. Don't worry. So at that time only I am going to allow it as application, not at the time when you invest in property. Now, next. Again, because of this, when they are claiming application, there is something called as excess application. So, there are judgments of 12 high courts. There is judgment of Supreme Court, Subros Educational Society. There is a judgment of Supreme Court. So what happened? Immediately they made an amendment. Immediately amendment is made telling that henceforth, don't tell loss. It is excess application. Henceforth, they are telling excess application of 1 year will not be allowed to be set off against the receipts which are unspent in the future assessment year in case of a trust. I am not going to allow that application. Now, Supreme Court judgment nullified. In any way in ITR 7, there was no column. Where is the column here? In ITR 7, there is no column at all to fill this. Plus, is there any section, any proviso in the Act 11, 12, 13? There was no section. Where is the question? So we were only claiming this based on the judgments of 12 high courts and the Supreme Court. But no column. In that column, nothing is there in the written ITR 7, as well as there was no section 11, 12, 13. Now, anyway, it is nullified. I told you Subros Educational Society, 2018, Supreme Court. Based on this, I could claim. But now they have nullified that. Both they have put everywhere, sir. They have put in 10 within bracket 23C. They have put in section 11 also. Both the places amendment are made. Stating what? Explanation 2, after 20th proviso, there are 20 provisos in 10 within bracket 23C. After 20 provisos in explanation 2 in 1023C, explanation 5 to section 11, subsection 1, clause A and B. Their explanation 5, here explanation 2. What it says, for the purposes of this clause, it is clarified that calculation of income required to be applied or accumulated during the previous year shall be made without any set off of any deduction or allowance of any excess application of any of the year preceding to the previous year. Law is clear, my dear friends, and now is the, now is the age of faceless assessment, faceless appeal, faceless penalty. So you cannot, claim this. It would be disallowed immediately and even penalty would be levied. Again, they are telling, what about your voluntary contribution made with a specific direction that it shall form part of the corpus, it shall be invested or deposited in one or forms of modes specified in subsection 5 of section 11, maintained specifically for such corpus. Now, what are they telling? You remove from the corpus. What you have to do? When you get the corpus donation, you have to invest in specified modes. Earlier 11(1)(d), it stopped there. Voluntary donation received with a specific direction, it shall form part of the corpus. Therefore, what they did? Thereafter, they have, added those words. It should be invested in any of the mode specified in 11(5). So what happens? Suppose I were to remove that corpus and spend during there. They are telling, don't worry, I will not disallow. You can't spend out of corpus. Next year, you refill the corpus. please refill the corpus next year by making the donation out of the current year, not of the accumulated, out of the current year income, current year donation, current year receipts. Refill that corpus again, then I'll allow as application. In the year when I remove that corpus fund and when I spend it, what was there in 11.5, I remove it and I spend it, application will not be allowed. But next year, when you refill that corpus, when you refill the corpus again in that 11.5 investment, I will allow you application. So that is welcome amendment again. So you see all these, amendments are made. Now, moving forward, business income. Now goodwill. Now again, goodwill amendments are made in Lok Sabha bill. What was goodwill? Again, one more Supreme Court judgment nullified Smith Securities Limited. What is it telling? Goodwill of a business or a profession is a depreciable asset. That is what held by Smith Securities 348 ITR 302. Now, what are they telling? Now they are telling we do not want to provide any depreciation on goodwill. Upon application of these provisions, in some cases, it results in no depreciation on account of actual cost being zero. Some other cases, a valid depreciation arises in accordance with aforementioned ruling. Fine. So, based on Smith Securities, they went on claiming. Now they are telling, seeing no justification in treating goodwill as a depreciable asset, it is now amended to provide that the goodwill of a business or profession will not be considered as a depreciable asset, entitling no depreciation. They have also added the word profession, my dear friends. Now again they are telling, what will be goodwill? It is like your land. It is worthless now. It is just lying in the balance sheet. It is like a land. No depreciation will be allowed. So what to do? Earlier I claimed the depreciation on goodwill, and now it is standing, it is there in my WDB of assets. What to do now? They are telling, hey, from now on, self-generated goodwill anyway it is nil, no problem. Whatever goodwill you purchase, just put it in the balance sheet and forget it. No question of claiming depreciation. What about the goodwill purchased earlier, sir? Already I have claimed depreciation. It is lying in my balance sheet. If I am going to sell that in subsequent years, what is the position? Now they are telling, don't worry. What to do? For the purpose of computation of capital gains, you please take cost of the goodwill, original cost of goodwill, less depreciation that was claimed by taking that as the only asset in the block. Take the cost of goodwill, less depreciation claim. So what is there? That you have to reduce it from the purchase price of goodwill. Again, now what are they telling? These are all the amendments made. Block of assets, they made the amendment. 2 within bracket 11. They made the amendment. Telling what? The block of assets shall not include the goodwill of business or profession. Yes. Because, what it says, block of assets 211, intangible assets, know-how, patents, copyrights, trademarks, licenses, or similar business or similar commercial or business nature, it says. So goodwill we used to claim in that. Similar rights there we used to claim, Smith Securities. Goodwill was not specifically mentioned there. But now specifically they are telling it will not include goodwill. Again, they made an amendment in 32 within bracket 1 clause 2, which provided for depreciation in case of intangible asset. So now what are they telling? In 32 subsection 1 clause 2 amendment is made, stating that goodwill of a business as well as a profession shall not be considered as an asset for the purposes of the clause and hence not eligible for considered as an asset for the purpose of this subsection. Now, what about your depreciable asset? Computation of capital gain in case of depreciable asset. Now, again, new proviso is inserted. Section 50, it provided for condition of applicability of provision of 48 and 49 for computation of capital gain in respect of all depreciable assets, where capital asset is an asset forming block of assets in which respect of which depreciation has been allowed. So proviso is inserted to, and then which says what? Where goodwill forms part of block of assets beginning on or 1st April 20, depreciation thereon has been obtained by assessee. WDV of that block and short-term capital gain, if any, shall be determined in the manner as may be prescribed. Now, similarly, 55, they made the amendment, 49, etc., telling that what? The cost of acquisition by purchase from previous owner would be the purchase price. In other cases, it will be taken as nil, not that 1/4/2001. Self-generated goodwill, I am not bothered. They say, I will not take fair market value on 1/4/2001. It would be nil. Now, what is the amendment made in the finance bill? 43/6, they are not touched upon. So that is what we discussed. What about the WDV of block of assets? What happened if goodwill which form part of an existing block of assets. That was the amendment made in Finance Bill of Lok Sabha. So once, my dear friends, asset enters the block of asset, it loses its identity and depreciation allowed on the whole block of the asset. Therefore, if an assessee has a block of intangible asset and in any previous year the assessee had acquired goodwill, which naturally will enter the block of asset, then how should depreciation be allowed on such block of asset? Now, Finance Bill passed in Lok Sabha made an amendment in 43 subsection 6 clause C, stating what? That the WDV of block of assets, as I told you, shall be reduced by the actual cost of goodwill falling within such block of assets. However, the actual cost of goodwill shall be first decreased by, this amendment came in 88-89. Amount of depreciation actually allowed to the assessee for such goodwill before assessment year 88-89 and amount of depreciation that would have been allowable to the assessee from the assessment year 88-89 as if goodwill was the only asset in the relevant block of assets. Again, while computing WDV for assessment year 21-22, if the depreciation was claimed on the goodwill forming part of block of assets in the immediately preceding previous year, amount of reduction calculated above shall not exceed the WDV of the block of assets. Don't worry, we have an example. Very, very simple, nothing to worry. So, if you see here, this is XYZ Limited. It's running a manufacturing business. Acquired intangible assets in an M&A transaction. Goodwill worth 100 crores, trademark 50 crores, licenses and franchise 50 crores. So how they are calculating, sir? Now they are telling trademarks sold in April 19 for 40 crores, situation 2 80 crores, 40 crores and 80 crores. So situation 1, situation 2. So goodwill 100 crores, trademarks, license. These are all the cost, block of intangible asset, less depreciation 50%, WDV 150, no problem. Now opening WDV 150, less intangible assets sold during the year. Case 1 40, case 2 80. So on the balance block of asset WDV, I am claiming depreciation, no problem. So 82.5, 52.5 is the scenario. Now I have to reduce adjustment on account of goodwill from this year onwards. So you please see here, actual cost of goodwill included in block of assets as reduced by previous year's depreciation. Here 56.25, here it's restricted because it cannot become negative. So this 56.2 point, very simple, sir. How to calculate? Take the cost of goodwill, claim depreciation as if it is the only asset in the block. So this I told you to purchase 2 years ago in the example, 100 into 25%, 25. Again 100 minus 25 into 25 is 18.75. So this is the WDV of the goodwill, 56.25. On this 56.25, claim again 25%, which is 6.56. So here it is 56.25. I have to reduce. Now because I am reducing goodwill including block of assets as reduced by previous year's depreciation. WDV of block of intangible assets. Here I told you to restrict it to the extent of WDV. Now, yes, sir. We move. Yeah. Now again, this employer, payment by employer of employee contribution to a fund on or before due date. So, 43B, 3615A. There is an amendment made. What are they telling now? They are telling 3615A, 43B, subclass B operate in different fields. Former takes care of employees' contribution, latter takes care of employers' contribution. So 43B is employers' contribution, employees' contribution, 3615A. Therefore, what are they telling? Ultimately, what are they telling? Yeah. What madam told was, you are depositing late. Employer is depositing late in the employee's account, thereby employee is unjustly enriched. Unjustly. Why? Because they are not getting interest, because this fellow is depositing late. So therefore, even if there is a 1 day delay, I am going to disallow this. I am going to disallow employer's contribution and employee's contribution 3615A. Employer's contribution is 43B. Employee's contribution is 3615A. They are telling employee is unjustly enriched because you are using the government money, the employee's money, because you are not depositing in time. So employee will lose that much interest. So you are unjustly enriched at the cost of employee. I will make a permanent disallowance. So in my opinion, there is a far bigger unjust enrichment in the case of employer, because I am not keeping the money with myself. If I wouldn't have deposited even before the filing of due date of return of income, then you should have as well taxed me. But having deposited, there is a double whammy now. I deposit the amount also with the government. On top of that, you are making disallowance and making me pay tax. That amount is not lying with me. All right, there was a delay. There was a delay of 1 day or 2 days, whatever. But beyond the relevant due date under statutory act under ESI and PF, but I deposited it before the due date of filing return. But nothing doing. Explanation 2, they are telling 3615A. Explanation 2 is added. 43B, explanation 5 is added. Explanation 2 in 3615, what it says, stating that the provision of 43B does not apply. Please understand the wordings carefully. Does not apply and deemed to never have been applied. That means what? That means what? It may, look like it is a retrospective amendment. Deemed to never have been applied for the purposes of determining the due date. Again, I told you 43B explanation 5. It says provisions of this section do not apply and deemed to never have been applied to a sum received by the assessee from any of his employees to which provisions of subclass 10 of class 24 of section 2 applies. Despite having a plethora of judgments, Karnataka High Court, plethora of judgments are there. Shabri Enterprises, and then, the AIMIL Limited Delhi High Court. Justice A.K. Sikri started it all in 2010. A.K. Sikri started it all, telling that what? Employer collected from employee, and he has to deposit in the under 3615A or 43B employer's contribution, 3615 employee's contribution. But because he collected from employee and employer is now depositing, it becomes de facto, it becomes employer's contribution itself on 43B. Justice Arjun Sikri in 2010 in AML High Court, he went on to become even Supreme Court judge. Integrity cannot be questioned. Excellent personality. He allowed that, stating that okay, you have remitted to the central government, so the due date is increased, and because you have remitted before the the due date of filing return. But now all the judgments, my dear friends, they are all nullified as on date, including Supreme Court judgment Alum Extrusion, 4 or 5 judgments of Karnataka High Court, Shabri Enterprises, ANZ. Next. Yeah. So there is one other amendment with this in 143A4. In your 3CD, class 20B, form 3CD, where 20B asks for details of contributions received from employees for various funds as referred to in section 3615A. So here also automatic adjustment will be done under 143(1), because if you do not pay before the due date, my dear friend, here automatically intimation will be generated and it would be added back here. Next. So as I told you, the litigation due to retrospective amendment, but in my opinion, you need not pay because the government is against all retrospective amendment, and because the amendment is made in this year, probably, only from this year the disallowance would be made. Although the language of the statute says, it seems like it's a retrospective amendment, cases can be reopened, but in my humble opinion, whenever you put explanation, it is deemed to be from when? Explanation deemed to be from the day the section was introduced. So, but therefore, in my humble opinion, but the government is against all retrospective amendments. So here, having been introduced from this year onwards, probably the government will not touch all the cases of past years. Anyway, next amendment, your 44AB. So here, it was 5 crores and it became 10 crores. So aggregate of all receipts in cash during the previous year does not exceed 5% of receipt. Aggregate of all payments in cash during the previous year does not exceed 5% of payment. So here, the government, in order to incentivize non-cash transactions to promote digital economy, further reduce compliance burden of all small and medium enterprises, the amendment was made to increase the threshold limit from 5 crore to 10 crores. The Finance Bill Lok Sabha, again, they inserted a new proviso stating what? For computation of limit of 10 crores, payment or receipt settled through a non-account pay check or non-account pay bank draft, because they told only cash, therefore bearer check, cross check, etc., open check. So now that would have been not included because it is not cash. So therefore telling nothing doing, they have inserted a new proviso telling payment or receipt settled through a non-account pay check or non-account pay bank draft, it shall also be deemed to be a cash payment or a cash receipt. Therefore, the same shall be included while computing 5% cash transaction limit under section 44AB. That was the amendment. Again, 44ADF. So here, we represented before Justice R.V. Ishwar committed, before this section came into, in the act, telling what? Please allow, sir, in case of professionals, 33 1/3% and let the limit be 1 crore. No. He told all your professionals, you are all rich people. I'll not accept 33 1/3%. I'll make it 50% and I'll not make the limit as 1 crore. I would make it only 50 lakhs. So that was the limit, presumptive income. Then what happened? Exactly cut copy paste they did. What was it? Benefit of existing 44 ADA. What was it telling? Benefit of this provision available to an assessee being resident in India. So ditto cut copy paste from 44 AD. They took that, telling what? Companies exclude an LP from the scope of presumptive taxation 44 ADA. So expressly limit the provisions of 44 ADA to a resident assessee being an individual, HUF or a partnership firm. They copied 44 AD and dumped it in 44 ADA, stating what? This provision is applicable to individual, HUF or a firm other than LLP. How can you apply, sir, 44 ADA to a HUF? HUF, then Naveen individual proprietor, Naveen HUF. Then there are two firms carrying on professional business. So sooner or later, good sense prevailed. An amendment is made in Finance Bill Lok Sabha. Now they have restricted the scope of 44 ADA. So now HUF shall not be eligible for presumptive tax scheme under 44 ADA. Now, for the effect from assessment year 21-22, only a resident individual or a resident partnership firm shall be eligible to compute income under the said presumptive taxation. Therefore, LLP, HUF, company, AOP, BOI shall not be eligible to claim the beneficial provisions of 44 ADA. Now, very beautiful section, sir. All amendments, all Supreme Court judgments, High Court judgment nullified. They have inserted section 9B. Let us go through the section. Now, what are they telling? Insertion of section 9B, listen very carefully. Income on receipt of capital asset or stock in trade by specified person from specified entity. So, what is the section now? 9B, subsection 1. What are they telling? Where a specified person receives during the previous year any capital asset or stock in trade or both from a specified entity. So, specified person is defined, specified entity is also defined. We will go through. So, specified person is receiving during the previous year. Therefore, forget mercantile system, forget cash system. Section itself uses the word receives. So, you have to be in receipt. See, based on mercantile system, it may accrue or it may arise in this year, but the receipt may be in a subsequent year. 9B will be applicable only on receipt, my dear friend. Next. Specified person receives during the previous year any capital asset or stock in trade or both from a specified entity. In connection with what? In connection with dissolution or reconstitution of such specified entity. So you are receiving, who is receiving? Specified person. Who is specified person? The specified person is, yes. Specified person means a person who is a partner of a firm or member of AOP or BOI. Similarly, who is specified entity? It is a firm or AOP or BOI, not being a company or cooperative society. Both the places it is there. Specified entity means a firm always, and specified entity means always a partner of a firm. So specified person is partner of a firm and specified entity is the firm. So specified person is receiving during the previous year capital asset or stock in trade when in connection with dissolution or reconstitution of such specified entity. So he has tapped both dissolution or reconstitution of such specified entity. Meaning of reconstitution is also given in the section itself. Then the specified entity shall be deemed to have transferred such capital asset or stock in trade or both to the specified person in the year in which such capital asset or stock in trade or both are received by the specified person. Subsection 2 says what? Profits and gains arising from such deemed transfer. They have introduced a new word, deemed transfer, for profits and gains. Profits and gains from such deemed transfer of capital asset or stock in trade by the specified entity shall be deemed to be the income of specified entity of the previous year in which such capital asset or stock in trade or both were received by specified person. They are telling it is deemed to be income in the year of receipt. Then chargeable to income tax as income of such specified entity under that profits and gains or under that capital gains in accordance with the provisions of this act. Now, subsection 3, what are they telling? For the purpose of this section, now the partner, the specified person has received from specified entity, what, sir? Capital asset or stock in trade. Capital asset or stock in trade, section 9B. Section 9B, who is the recipient? Specified person. Who is specified person? Partner of a firm. Who is from whom? Specified entity. Who is specified entity? The firm. What they have given, sir? They have given what? They have given stock in trade. They have given capital asset. In connection with what? What is the situation, event? When is the event? What have they given? It is on dissolution or on reconstitution of the firm. Dissolution or reconstitution. What do you mean by reconstitution? Please, it is given in the explanation. There are three types of reconstitution. When there is a reconstitution where one or more of its partners or members, as the case may be, of such specified entity ceases to be partners or members. One or more members of partners or members. That is on retirement, or it may be even death. For example, there are four partners: Naveen, Rishi, Lalit, and Sanjay. There are four partners. So Naveen and Lalit, they retire from the firm. One or more of the partners or members, as the case may be, of such specified entity ceases to be partner. That amounts to reconstitution, my dear friend. Again, next situation. One or more new partners or members, as the case may be, are admitted in such specified entity. In such circumstances, please understand carefully, in such circumstances that one or more of the persons who were partners or members before the change continue as partner or partners or members after the change. For example, I told you there is a firm, Naveen, Rishi, Lalit, and Sanjay. Now Brijesh comes in. Now Brijesh comes in as a partner. So one or more new partners. So new partners being added and the old partners are also continuing. In such circumstances that one or more of the persons who were partners or members of specified entity before the change continue as partner. Third situation. All the partners or members, as the case may be, of such specified entity continue with a change in their respective share or in shares of some of them. Please understand, with a change in respective share or in shares of some of them. Again, all the partners, Naveen, Rishi, Lalit, Sanjay, equal partners, 25, 25, 25, 25. Now what happens? There is a change. Why? It becomes, say, for example, 30, 30 and 20, 20, the profit sharing ratio. With a change in a respective share or in shares of some of them. So 30, 30, 20, 20. Again, that amounts to reconstitution. Okay. So the meaning is given in the explanation itself. What is reconstitution? Now, fair market value of the capital asset or stock in trade on the date of receipt by the specified person shall be deemed to be the full value of consideration. Very simple, sir. How to value? They are telling take the fair market value. 222B defines what is the fair market value. Take the fair market value and it will be prescribed in the rules now, not yet prescribed. And that will be the sale consideration. Date of its receipt by the specified person shall be deemed to be the full value of consideration received or accruing as a result of such deemed transfer of capital asset or stock in trade. I repeat again, it is capital asset or stock in trade. Issue number 1. What happens if the Lalit retires from the firm and he is given an agricultural land? It is not a capital asset. Don't worry. Let the fair market value of agricultural land be 25 crores. Agricultural land is at Devanalli. Lalit retires from the firm and Lalit is given, agricultural land situated at Devanalli, for example, and it is not a capital asset, and 2 within bracket 14 subclass 3, it is not a capital asset. It should be a capital asset. So therefore, in my opinion, there would be no, capital gain tax under 9B, no question of capital because it's not a capital asset. Next, issue number 2. Suppose the firm is paying tax under 44AD, sir. Presumptive income. Firm is paying tax. You can pay tax. It is not a LLP. Firm is paying tax. Yes, sir. Now Lalit has retired from the firm. Yes, sir. Again, you are giving him not only this, I am telling you, not agriculture land. You are giving him a land. You are giving him a land at Devanalli. Then it is taxable, my dear friend. Even though it is 44AD, in my humble opinion, 9B will be applicable. Even 44 will be applicable. Anyway, these are all various issues. We will go through the section. We will create more issues. So don't think here 44AD, this will not apply. 100% it will apply. Next, receiving or accruing as a result of such deemed transfer of capital asset or stock in trade or both by specified entity. Now, subsection 4 says what? If any difficulty arises in giving effect to the provisions of this section and 45.4, then obviously the board may, with the approval of central government, issue guidelines. And then subsection 5 says every guideline issued by the board shall be laid before each house of parliament and will be binding on the income tax authorities and on the assessee. Explanation, we saw that reconstitution of the specified entity. Now, please understand now 9B. What is 9B, sir? We are in 9B only. I have not come to 45.4. Distribution of stock or capital asset by a firm to its partner is deemed as transfer. So deeming fiction is created that distribution of stock or capital asset by a firm to its partner is a transfer. Why? Because, whole lot of judgments are there. this is done to overrule a whole lot of judgments. I do not want to go into old, provisions. Why? Because the various judicial rulings which held that the distribution, division or allotment of assets by a firm upon dissolution, upon reconstitution is nothing but a mutual adjustment of rights between partners. For example, the Supreme Court judgment was there already. In the case of Malabar Fisheries versus, CIT, reported in Taxman, Supreme Court judgment held that a partnership firm under the Indian Partnership Act 1932 is not a distinct legal entity apart from the partners constituting it. The firm as such has no separate rights of its own in the partnership assets, and when one talks of the firm, property or firm's assets, all that is meant is property or assets in which all partners have a joint or common interest. Very important. If that be the position, it is difficult to accord the contention that upon dissolution, firm's rights in the partnership assets are extinguished. The firm as such has no separate rights of its own in partnership assets, but it is the partners who own jointly in common its assets. Therefore, the consequence of the distribution, division or allotment of assets to the partnership which flows upon dissolution after discharge of liabilities is nothing but a mutual adjustment of rights between the partners, and there is no question of any extinguishment of the rights in partnership assets among to and transfer of the asset within the meaning of 2 within bracket 47. So this is basically one judgment. Host of judgments are there. Everything nullified, sir. All nullified now. And that too, it is applicable from 1st of February itself, on that very day when the amendment was made. Now, again, so how to compute capital gains from deemed transfer? You know that. Stock in trade shall be deemed to be income, as well as if capital asset you have received, deemed to be income. If stock in trade is deemed to be income, it will be taxed under that profits and gains, sir. No problem. If they what to tax? Fair market value, absolutely no problem. And it will be taxable as per section 28, fair market value of stock transferred to partner shall be recorded as sale by the firm, as the same shall form part of the business of the firm. Even GST liability will be attracted, sir. It will be treated as sale by the firm. Then next, deemed transfer of capital asset. Yes, sir. No problem. 9B subsection 2. What is it? Deemed to be income of the firm in the year in which capital asset is received by partner. It shall be charged to tax under that capital gains. No problem, sir. What is the fair sale consideration? Fair market value of the capital asset on the date of receipt by the partner shall be deemed to be full value of consideration while computing capital gain arising from deemed transfer of such capital asset. So, all other provisions would apply under that capital assets, like nature of capital asset, period of holding, cost of acquisition, full value of consideration, etc. Section 48. Next. Again, you see, very important, section 48 also has been amended by the Finance Bill Lok Sabha to mitigate the double taxation arising due to introduction of 9B and substitution of 45(4). So 9B only we have done. When we see 45(4), you will come to know that it may lead to a double taxation. Therefore, how beautifully the statute amendment is made, section is provided at. So 48 subclass 3, what is it telling? To provide that the profits and gains chargeable to tax under 45(4), which is attributable to capital asset being transferred by the firm, shall be reduced while computing capital gain in the hands of the firm in respect of such capital asset. Why? I will tell you. 45(4), here what is received, sir? 9B, capital asset, stock in trade, received by partner from the firm. In 45(4), what is received, sir? Money is received, capital asset received. Same. 45(4) is what? Money is received, capital asset is received. So there also capital asset, here also capital asset. The double taxation. Therefore, 48(3) already amendment is made. Section is introduced, inserted. Provide what? Profits and gains chargeable to tax under 45(4), which is attributable to capital asset being transferred by the firm, shall be reduced while computing capital gain in the hands of the firm in respect of such capital asset. No question of double taxation. Therefore, in other words, the amount of capital gain computed in 45(4), which is attributable to capital asset being transferred by the firm, shall be deducted while computing capital gain in the hands of the firm in respect of such capital asset. Now, this is, how to compute. 9B read with 48(3). How to compute now? 9B read with 48(3). Because I told you 45(4) will apply, where capital asset received by a partner from a firm, 9B would also apply, 45(4) also would apply. So therefore, this is the computation under 9B, read with 48.3. Full value of consideration, sir, that is FMV less expenditure incurred wholly and exclusively in connection with transfer, cost of acquisition or index cost of acquisition less index cost of improvement or cost of improvement, etc. Less, very important, amount chargeable to tax as income of the firm under section 45(4), which is attributable to capital asset being transferred by the firm. And then you can also claim, my dear friend, exemption 54 to 54 GB to the extent of net result of above calculation. That is on capital gain, not on sale consideration, 54 to 54 GB. Then income taxable under the head capital gains. Next. Now we go to 45(4). Please see 45(4) how it starts. 45(4) says, notwithstanding anything contained in subsection 1, 45(4), overrides 45(1). Notwithstanding anything contained in subsection 1, where a specified person, again, don't worry, partner, receives during the previous year any money or capital asset or both. You may receive money, you may receive capital asset or both from the specified entity. In connection with reconstitution, please understand, there is no word dissolution here. There is no word dissolution here. 45(4) is telling what? Specified person receives money or capital asset in connection with only reconstitution, whereas 9B is telling what? The specified person receives capital asset or stock in trade in connection with dissolution or reconstitution. 45(4) is telling specified person receives any money or capital asset in connection with reconstitution and not dissolution. So then it continues. Then any profits or gains arising from receipt of such money by the specified person shall be chargeable to income tax as income of such specified entity under the head capital gains. That is why they are telling, double taxation. Here also capital gain, there also capital gain. Therefore, 48(3) has been inserted. Now, shall be deemed to be the income of such specified entity of the previous year in which such money or capital asset or both were received by the specified person. Then, and notwithstanding anything to the contrary contained in this act, such profits or gains shall be determined in accordance with the following formula, namely, A is equal to B plus C minus D. My good friend Brijesh is now, racking his brains, and now he's telling what is that? A is equal to B plus C minus D. A is equal to B plus C minus D. If there is 45(4), my dear friend, just remember the formula. A is equal to B plus C minus D. What is A? Naturally, capital gain. A is capital gain. What is B? I told you can receive money, you can receive asset. So B is what? Value of money received by the specified person from specified entity on the date of such receipt. A is capital gain. A is equal to B plus C minus D. What is A? Capital gain. What is B? Value of money received. What is C? C is the market value of capital asset. Your fair market value of capital asset received. So then what is D? Minus D. What is D, sir? Amount of balance in the capital account represented in any manner of the specified person in the books of accounts of specified entity at the time of its reconstitution. So balance lying to the credit of that partner's capital account. Partner capital account, that person, amount of balance in the capital account represented in any manner of the specified person who is receiving the money or receiving the asset. What is his capital outstanding as on that date? At the time of what? At the time of reconstitution, because it is not, contemplating dissolution here in 45 subsection 4. So therefore, again, they are telling, provided that if the value of A in the above formula is negative, its value shall be deemed to be 0. So the value of A cannot be negative. It will be deemed to be 0. Next. So here, provided further that the balance in capital account of the specified person in the books of the account, says second proviso, of the specified entity is to be calculated. What? Balance lying to the credit of partner's capital account on the date. Which date? On the date of receipt, of specified entity is to be calculated without taking into account the increase in capital account of specified person due to revaluation or due to self-generated goodwill or any other self-generated asset. So now they are telling, I don't believe in this your revaluation concept. There is a land and building of the firm. You go for revaluation. You create a revaluation reserve. You increase the cost of land or building. Then this fellow retires and enhanced cost of land or building is given. All that nothing doing is telling. Remove all revaluation. Then only you calculate they are telling. Remove revaluation. Then you calculate your capital account. I don't want all this, loopholes plugged. It does not recognize revaluation at all. Then explanation 1, the reconstitution of specified entity, meaning of specified entity, specified person shall have the meaning respectively given in 9b. We saw the meanings are reconstitution, 3 situations, specified entity, specified person, etc. Again, self-generated goodwill, self-generated asset means goodwill or asset as the case may be, which has been acquired without incurring any cost for purchase or which has been generated during the course of business or profession. Next. Explanation 2, it says, for the removal of doubts, it is clarified that where a capital asset is received by a specified person from a specified entity in connection with the reconstitution of such specified entity, the provisions of the subsection shall operate in addition to the provisions of 9b, and the taxation under said provisions thereof shall be worked out independently. But there 48.3 is there to save you. So 48.3 will also save your skin, but here will be worked out independently. Next. So 45.4, what is it telling now? 45.4 provides for computation of capital gain, which arises to a partner on extinguishment or relinquishment of his right in the firm in connection with reconstitution of the firm. Though the income arises to partner, but it's deemed as income of the firm. Anyway, the firm is only paying tax in both these situations. You need not worry. Thus, the firm will be assessed under section 9b for its own income and under section 45.4 for income arising to a partner thereof. Next. So 9b versus 45.4. 9b provides for taxability at the time of dissolution or reconstitution. Absolutely no doubt, sir. 9b, dissolution, reconstitution. 45.4 is what? Only at the time of reconstitution. It does not envisage dissolution. Next, where any asset or money is transferred to a partner or a member at the time of dissolution, same amounts to extinguishment or relinquishment of rights. Term transfer as defined under section 247 covers extinguishment, relinquishment of right within its ambit. However, since such rights are not extinguished or relinquished in favor of another person in case of dissolution, then this one derives any benefit from the same. Therefore, 45.4 does not apply at the time of dissolution. Anyway, the word dissolution is not there in 45.4. Why should I break my head? What it uses the word only reconstitution. Next. So 48 capital gain, you know that. 9b deals with taxability of income arising to firm on transfer of capital asset to a partner in connection with dissolution or reconstitution. 45.4 is only income arising to a partner on receipt of capital asset in connection with reconstitution. However, tax is charged in hands of firm only. Therefore, that double taxability was there, arise under read with 45.1, read with 9b, second and 45.4. To remove the impact, 48 is amended. That, yes. Next. So, there may be a lot of issues going forward, but these are all the, it may require 1 hour to deliberate on these 2 sections itself, taking into account a whole lot of issues. But these 2 are the sections, and no tax planning, my dear friend. It is applicable from that assessment year itself, from 1st of April itself. So you have to go back, rework the strategies on the boardroom, and you'll have to, whatever tax planning was done, you need to pay advance tax also. Next, your 43 CA. Increase in safe harbor limit of 10% for home buyers and real estate developers selling such residential units. So you know that in order to boost the demand, the real estate sector, to enable the real estate developers to liquidate their unsold inventory at lower rate to home buyers, increase is made in safe harbor limit from 10% to 20%, subject to fulfillment of following conditions. Transfer of residential unit takes place only during 12th of November 2020 to 30th of June 2021. 12th of November 2020 to 30th of June 2021. Transfer is by way of first time allotment of residential unit to any person. Then the consideration received or accruing as a result of the transfer does not exceed rupees 2 crores. Then further, explanation is inserted to 43 CA to define the expression residential unit. It means what? It means an independent housing unit with separate facilities for living, cooking, and sanitary requirement, distinctly separated from other residential units within the building, which is directly accessible from an outer door or through an interior door in a shared hallway and not by walking through the living space of another household. Consequential amendment is also made in 56(2)(10) to increase the safe harbor from 10% to 20%. Accordingly, for these transactions, circle rate shall be deemed as sale or purchase consideration only if the variation between the agreement value and circle rate is more than 20%. So it's applicable from assessment year 21-22, 1st April 21. Now, again, slum sale, there was an amendment in this finance bill also. What is slum sale? You know, 242C. Slum sale means transfer of one or more undertakings as a result of sale for lump sum consideration without values being assigned to individual assets and liabilities, leading to interpretation by courts that what? That a transfer in relation to word transfer in relation to capital asset like exchange, relinquishment, etc. are to be excluded. So all this while they were only telling that what is monetary consideration. Now because of the amendment, even non-monetary consideration is included. Earlier what? The courts were telling no, because you are using the word sale, it means only monetary consideration. So now they are telling interpretation by courts that other means of transfer in relation to definition of the word transfer in relation to capital asset like exchange, relinquishment, etc. are excluded. So now they are telling nothing doing. I am going to include all this. Why? Based on the Supreme Court ruling in Dhampur Sugar Mills and Artex Manufacturing, it covers even non-monetary consideration under the word transfer, which in effect and substance is in nature of sale. So therefore, my dear friend, from 1st of April 21, what has happened? Transfer of one or more undertakings by any means, not only by sale, exchange, relinquishment, extinguishment, etc. Even if shares are exchanged, you give bonds, etc. Still it amounts to transfer on 242C. Earlier only sale. Now even non-monetary consideration, they are telling it becomes a slum sale and 2 within bracket 42C. Why? Now they are telling the word transfer on par with section 2 within bracket 47. Now basically they are relying on the Supreme Court rulings in Dhampur Sugar Mills and Artex to cover even non-monetary transaction under transfer. So this amendment will again overturn very famous judgment of Bombay High Court ruling CIT versus Bharat Bijli Limited, where the Bombay High Court made a distinction between the slum sale and slum exchange. Now, so FMV of capital assets transferred under slum sale to be calculated in prescribed manner. So 50B is there, 50B, 242C. So what is 50B? Where undertaking or division is acquired, then net worth of that undertaking or division is deemed as the cost of acquisition. Benefit of indexation shall not be available, even if the undertaking under slum sale is deemed as long-term capital asset. So where is the computation of net worth mechanism provided in explanation 2 to 50B? It also provides that for computing net worth, depreciable assets are taken at written down value, non-depreciable assets obviously at book value. Further, all those capital assets which are fully allowed as deduction, 35AD, are obviously taken at nil value. Now, that existing 50B, it did not contain any provision for computation of full value of consideration in relation to transfer of the undertaking under a slum sale. So therefore, amendment is made here in Finance Bill Lok Sabha. They have amended 50B subsection 2 to provide that fair market value of capital assets, that is being an undertaking or division transferred by way of slum sale as on the date of transfer, shall be calculated in the prescribed manner. Rules will shortly come. Therefore, such FMV shall be deemed to be full value of consideration received or accruing as a result of transfer of such capital asset. One more new clause was there in explanation 2 was inserted to provide that the value of capital asset being goodwill which has not been acquired by the SSC by purchase from previous owner shall be taken as nil while computing the net worth. Now, we move forward. This is one small amendment, I think. Yes. Yeah. Tax neutral conversion of cooperative bank into banking company. So here, what are they telling? Amendment is made here to expand the scope of business reorganization to include conversion of a primary cooperative bank to a banking company, and the deduction available under 44DB shall also be made applicable in relation to such conversion of primary cooperative bank to the banking company. Likewise, amendment is also made to provide that the transfer of a capital asset by the primary cooperative bank to the banking company as a result of conversion and consequential share allotment to shareholders of cooperative society shall also not be regarded as transfer under section 47. Now, some amendment in deductions. You know that 80IBA 100% deduction of profits derived from business of developing and building affordable housing project. It extending the deduction benefits of 80IBA to all the migrants because of this COVID. Migrants, they face a lot of problems. So they are telling if there is a rental housing projects which is all let out to migrants notified by the central government and fulfill such conditions as specified in the said notification. So they are also to promote affordable rental, and new subsection 1A was inserted in 80IBA. Amendment is also made to provide that the outer time limit for 31st March 2021 in this section for getting the affordable housing project approved be extended to 31st of March 22. What was 31st March 21? Extended by one more year, 31st March 22. And the same outer time limit be also provided for the affordable rental housing project. That, again, amendment is made in 80IBA to clause A. Next. This date of sanction for affordable residential housing property 80EA again extended by one more year, sir. From 31st of March 21, it is now extended to 31st of March 22. You know that interest on loan 80EA provides interest on loan, deduction for interest on loan for a residential house property from any financial institution up to 1.5 lakh where loan has been sanctioned during the period 1st of April 19 to 31st March 21, and now it was applicable only to available to first time home buyers, and that too, the fair market value should be less than your stamp duty valuation less than 45 lakhs. Now it is extended to that loan sanction extended by one more year to 31st of March 22. Then again extension of date of incorporation for eligible startup for exemption and for investment in eligible startup. So 80IESC provides for deduction of 100% of profits derived from an eligible business by an eligible startup for 3 consecutive years out of 10 years at the option of the SSC. That eligible startup should be incorporated on or after 1st of April 16, but before 1st of April 21. So then what are they telling? 54 GB was also there, providing for capital gain exemption arising from transfer of residential property owned by eligible SSC if the net consideration was utilized in subscription of equity shares of the eligible startup. Now it has been provided that the benefit is available only when the residential property is transferred on or before 31st of March 21. So now they are telling, I am going to extend one more year for you, 31st March 22. So you want to invest, you want to sell your house, entire life you work to build one house. That house they are telling you sell that. What to do? You please invest in eligible startup. Sell the house, invest the proceeds of the house in eligible startup. I will give you deduction 54 GB. So choice is yours. If the startup does not take up, you are selling the house, investing in shares of a startup, you are claiming 54 GB. But if the startup, the startup does not take up, then the SSC is in a real problem. Anyway. So now they are telling, as I told you, one more year it's extended. Date of incorporation extended on or before 1st of April 22 from 21. And even for 54 GB also is telling, don't worry. For that also I'm giving one more year extension from March 21 to March 22. Set off and carry forward of losses. So here, same thing they are telling. What is this? Madam Nirmala Sitharaman, what she told, there is a bad bank, disinvestment they wanted to of government. So all these banks having a lot of NPS, she came on interview and she told, I will create a bad bank. All these NPS, I'll take from the bank, I'll dump it in your bad bank so that you can continue to do the business of banking happily. Don't waste time on recovery of NPS. So therefore what to do? Whatever is transferred, so along with that you will transfer your carry forward loss, your set off of accumulated losses, unabsorbed depreciation, etc. in your amalgamation or demerger, etc. So therefore 219A amendment is made, 72A also amendment is made, and now she is telling that I will allow you, even you can carry forward your loss, your under 72A as well as your unabsorbed depreciation also. So explanation 6 is also inserted in the definition of 219AA. Next, your TDS, TCS advance tax. Now, First amendment is made here. What is it telling here? Tax at source on payment of dividend to a business trust in whose hands dividend is exempt. So as per the extent provisions, while dividend income and interest on securities paid by SPVs to business trust has been exempted from tax in the hands of business trust. That is your InvIT or REITs or InvITs. Under 1023 FC, SPV paying such dividend is required to withhold tax on such dividend at the applicable rates provided in 194. So now they are telling 194A is applicable to payment of interest other than on securities, providing the specific exemption on interest paid by SPV to business trust. But similar provision was not there for dividend. So therefore, now they are telling exemption is not provided in 194 for dividend income by SPVs to business trust. So therefore, it was not there. So now, in order to cure this inconsistency between the chargeability of dividend income and withholding of tax with respect to such income in the hands of business trust, amendment is made to second proviso to 194 to provide that the provisions of this section shall also not apply to such income credited or paid to a business trust by a special purpose vehicle or SPV or payment of dividend as may be notified. This also welcome amendment, sir. Advance tax relaxation on dividend income. Like, when is advance tax payable? They are telling there are 4 installments, June, your September, December, March, etc. So if there is a failure to pay advance tax installment on time 208, company declares dividend, you are receiving dividend. Suppose they declare and receive dividend in March. They are telling, I don't know. You pay for all the 3 installments also, as well as March installment. So they are telling, no, sir, here only on receipt of dividend. Fine, they say. That exception is again brought in 234C. So that is welcome amendment. Only advance tax will be payable only after the dividend income is declared and on receipt of the dividend income. Next, TDS on purchase of goods. So now they have inserted a new provision 194Q saying what? To levy TDS at 0.1% on the buyer on any sum payable to a resident for purchase of goods if the value or aggregate of value of purchase exceed 50 lakhs in any previous year. So the provision is applicable only on buyers whose total sales, gross receipts or turnover from the business carried on by them exceed 10 crore rupees during the financial year immediately preceding the year in which purchase of goods carried out. Ditto provision 206C1H, sir. That was on seller. Now they are telling for buyer. Now 194Q is introduced for buyer. 206C1H was for seller. So now they are telling same thing, sir. 10 crores in the preceding year, turnover of buyer, turnover of seller, 10 crores, 50 lakhs receipt, here 50 lakhs paid. This is 206C1H, this 194Q. So therefore, they are telling what here? Which is applicable. They are telling, don't worry, TDS I'll give precedence to 206C1H. Suppose the turnover of the seller, turnover of the buyer in the preceding year is more than 10 crores. And also the sum paid and sum received more than 50 lakhs. They are telling, don't worry, we will give importance to TDS. We will give importance to 194Q. If it is done under 194Q, you need not collect TCS under 206C1H. So we are giving importance to 194Q. Then, and wherever TDS is deducted, TCS again need not be collected. If at all TCS is collected, again TDS need not be deducted again. Now, TDS and TCS on non-filer at higher rates. Very important provision, sir. TDS, TCS on non-filer at higher rates. Now, for example, most of these contractors, the TDS and TCS also should be more than 50,000 per annum. Now, last 2 years returns, the contractors anyway says, I don't want to file return of income. TDS and TCS deducted more than 50,000, sir. So this time, when your assessee makes payment to these contractors, TDS or he is collecting TCS, you have to deduct double the rate, sir. Double the rate of TDS specified, double the rate of TCS specified. Question is, how do you know? Brijesh, my good friend, is asking, how do you know, sir? You are deducting, you are collecting. How do you know, sir? Now, their option will be enabled, sir, in the TDS return itself. When you put the PAN number, when you put the TAN number, it will show how many years return they have filed. If they have not filed for 1 year, if they have not filed for 2 years, if they have not filed for 3 years, immediately it is your duty now to deduct at double the rate now. If the TDS and TCS in last 2 years in which return is not filed, minimum 50,000 as per your 26 years. We can know whether these fellows have filed the returns of income or not. Now presently 206A, there is a higher rate of TDS for non-furnishing of PAN already there in the statute. Similarly 206CC, it is already there in the statute. higher rate of TCS for non-furnishing of PAN. So now they are telling similar needs to ensure filing of return of income. They want to increase the tax base. Ensure filing of return of income by those people who have suffered a reasonable amount of TDS TCS. Finance Act 2021 has now inserted 206AB in the Act as a special provision providing for higher rate of TDS for non-filers. Similarly, even 206CCA is inserted as a special provision for providing for higher rate of TCS for non-filers of income tax return. So what is the rate, sir? 206AB and 206CCA. Who is a specified person? I told you, who has not filed return of income for both of the 2 previous years in which tax is required to be deducted or collected as the case may be. Aggregate of TDS and TCS, I told you in his case is INR 50,000 or more each of these 2 previous years. However, the specified person shall not include a person non-resident who does not have a permanent establishment in India. Now, higher rates. Rate of TDS for such specified person shall be higher of for 206AB as well as it is given here 206AB as well as 206CCA. Yeah. So please see here 206AB. Rate of TDS for such specified person shall be higher of twice the rate specified in the Act or twice the rate in force or rate of 5% higher of the 3. TCS shall be higher of twice the rate specified in the Act or 5%, whichever is high. So all provisions are there, sir. Next. Example is also given. Now, yes, sir. Tax returns, refunds. Tax returns, refunds and interest. Now the finance minister is telling 75th year of India's independence, I want to give relaxation for certain category of senior citizen from filing income tax returns. Thank you very much, sir. What are the conditions? The senior citizen should have attained the age of 75 years or more during the previous year. Our senior citizen should have only pension income. Our senior citizen should have interest from the same bank in which he is receiving his pension income. So the interest should be credited to in the same bank in which pension is credited. If you have got 2 different banks, if you have got one FD, you have got capital gains, you have got mutual fund dividends, you have got dividend on shares, nothing doing, you have to file return of income. So therefore, pension income and interest from the same bank in which the pension income is credited. And then bank should be a specified bank. Government will notify few banks to be notified banks. And also, it should be required to furnish a declaration to the specified bank containing such particulars in such form and verified in such manner as may be prescribed. Once the declaration furnished, what will the bank do? Bank will be required to compute the income of our senior citizen after giving effect to the deduction allowable under Chapter 6A and rebate allowable under 87A for the relevant year, and then deduct tax. Please mark the word deduct tax. Bank will have to deduct tax under 194P on the basis of rates in force. So if you do all these things, you need not file return of income. Suppose I want refund, sir. Without filing return, I can't refund. I can't claim refund. Senior citizen will tell me, what about my refund? I can't claim unless I file the return. So therefore, to fulfill all these conditions, once this is done, there will not be any requirement of furnishing return of income by such senior citizen for this assessment year. That is 194P. Now your assessment procedures. There are return filing due date extension in some cases, reduction of time to file belated return and to revise original return, and removal of difficulty in cases of defective returns. So my dear friends, due date of filing return for an assessee who is a partner in a firm which is liable to furnish an accountant report under 92E, your transfer pricing report in Form 3 CEB under Section 92E. What was the due date for the firm, sir? Example, it was 30th of November. Therefore, now they want to align the due date for partner of such a firm also to 30th of November. So to that extent, amendment is made. Next, due date to file return of income by spouse of a partner. Now, if the firm or LLP required to get accounts audited, what is the due date, sir? 31st October. Similarly, due date to file return of the partner also shall be 31st October. However, no such extended time was available to the spouse of the partner who is covered under Section 5A. So what is Section 5A? It applies, equal apportionment of income except your salary income between spouses governed by Portuguese Civil Code And this provision is there in state of Goa and Union Territories of Dadra and Nagar Haveli and Daman and Diu. So for them also, what are they telling? I now extend the due date. What will the due date, sir? Therefore, I told you it was 30th of November in case of, for the firm which is required to furnish audit report under Form 3CE under Section 92, 30th November. Therefore, in case of a firm also which is required to furnish a transfer pricing report in 3CEB, due date for filing also shall be 30th November. But there is no such corresponding extension to spouse of the person governed by Section 5A. So now, Finance Bill Lok Sabha now extends the due date for filing of return by the spouse of partner of a firm if governed by provisions of 5A to 30th of November, where such firm is required to furnish report under Section 92E. Next. Now there is a reduction in time limit to file revised and belated return by 3 months. Earlier, what was it, sir? If you have not filed the return before the due date, it is you file after return after due date. What is it? It is regarded as belated return. Further, the taxpayer has an option to revise a return to correct any error or omission in original return. What was the due date for filing revised return or belated return, sir? Before the completion of assessment year, before the expiry of assessment year. Now, existing provision, what was it, sir? 31st March of the relevant assessment year. Now, the reason for the amendment to reduce 3 months, department becoming more tech savvy, time taken to conduct and complete such processes has greatly reduced. Mind you, the due dates are extended only because of this COVID. Otherwise, once the things normalize, you will find it very difficult. You will have to, do all the things within the due date specified. Now, therefore, because of this, in the light of the development, amendment is made to reduce the time limit to file the revised and belated return by 3 months. So what happened? Wordings were not that, elegant. So therefore, Finance Bill Lok Sabha has redrafted the wordings now. What was the wording earlier? Earlier, the Finance Bill provided that it is 3 months only, but 139.4, 139.5 to provide that belated and revised return can be filed at any time within 3 months prior to the end of relevant assessment year or before the completion of assessment, whichever is earlier. So this, they say, wordings were not elegant. They redrafted the wordings, although intent is the same. Now it is provided that belated and your revised return can be filed before 3 months prior to the end of relevant assessment year or before the completion of assessment, which is earlier. Therefore, my dear friend, what after the due date, belated and revised return in respect of assessment year 21-22 and subsequent assessment years can be filed only up to 31st of December of that assessment year. After 31st of December, there is no work for the chartered accountant. The portal, you cannot access the portal, you cannot file a return. Now, my dear friend, take the opportunity for assessment year 2021, due date of filing belated return extended up to 31st of May. So please try to file the returns. Earlier, what we were doing up to 31st of March. Now, as of last week, due date is extended up to 31st of May. So 2021, you can file up to 31st of May 21. Use the opportunity, file all the returns, file all the belated returns and revised returns up to 31st of May. Time is there. It may be extended further also. Even section 148, my dear friends, notice is also extended. What was 30th April has now become 30th of June. Be careful. So don't worry, the 13-14 notice will continue to come now. What was 30th, what was 31st of March, it became 30th of April, and now it is extended to 30th of June. Anyway, so there is, one more insertion of proviso to explanation in 139.9, defective return, to eliminate the ambiguity. Explanation to 139.9 provides a list of conditions owing to which a return will be pronounced as defective. So now the board is telling, in order to address grievances urging the board to notify class of assessees to whom such conditions shall apply or shall apply with modifications. Next, 234F. Now I told you after 31st of December, for a chartered accountant or an office dealing purely in tax practice, there would be no work of filing return, sir, because the portal will not enable to you to file revised return, belated return, original return. You are finished. Therefore, 234F also, there was no amendment. Why? Because I am filing after, December, and up to March, it was 10,000 rupees penalty. So now they are telling when you can't file the return after 31st December, it would be only how much now? Up to 31st of December, it would be only 5,000. 10,000 penalty is removed under 234F. So the fee for default, what was it at present? It was up to 5 lakhs after due date. The income up to 5 lakhs after due date, 1,000 rupees. Above 5 lakhs after due date, but on or before 31st December of relevant year, 5,000. Above 5 lakhs after the due date, but between January 1 and March 31st, it is 10,000 rupees. So now in the Finance Bill 2021 Lok Sabha, they have made an amendment. Last date cannot exceed 31st December. Higher, the late filing fees of 10,000 cannot be levied in any situation. Therefore, the Finance Bill Lok Sabha has made a consequential amendment to Section 234F that the late filing fee shall be rupees 5,000 only. Now, quickly we move forward. Default in linking Aadhaar and PAN 139AA. You know that every person who be allotted PAN as on July 1, 2017 and who is eligible to obtain Aadhaar number shall link the PAN with Aadhaar. And in case you fail to do, PAN allotted will become inoperative after the notified due date. It's been extended from several years now. Last 3 years extended. Latest due date is what? What was 31st March has now been again extended up to 30th of June. So Finance Bill has now levied a new section saying what? I will levy a fee for default in intimating Aadhaar. You know, a person is required to intimate his Aadhaar and Section 139 AA subsection 2. Then if you fail to do so, you will be liable to pay a fee not exceeding 1,000 at the time of making such intimation. Therefore, if a person fails to link PAN Aadhaar by 31st of March, now obviously extended, you will be liable to pay a fee maximum of 1,000 rupees. This fee will be in addition to other consequences the person has to face if the PAN becomes inoperative due to non-intimation of Aadhaar. Now, as per Rule 114 AAA, what it says, where a person is required to, furnish PAN, then as usual, deducted a higher rate as per Section 206 AA. Tax shall be, collected at a higher rate as per 206 CC. Taxpayers will not be able to file the return of income. Consequently, you shall be liable for consequences of non-filing of a return. Inter alia payment of late fee under 234F, interest under Section 234A, forfeiture of current year losses, so on and so forth. Best judgment assessment because non-filing of return, penalty for concealment of income, and then prosecution for failure to furnish return of income, so on and so forth. Penalty and 272B shall also be levied on such person may not be able to comply with the provisions of 139A requiring to quote his PAN in certain financial transactions. Now, this is April, now further extended, and here this is the tweet of for this linking of Aadhaar with PAN. I think let me just put the charges, sir. It is I am just yes. Let me just log in. Yes, sir. Yeah. Now, moving forward. Now, what about 141? Next amendment is 142(1) with effect from 1st of April 21. 142(1), what is it? 142(1). 142(1) is if you have filed a return, they may ask you for certain details. If you have not filed a return, they will ask you, please file return of income. Who can issue 142(1) notice? It can be issued only by an assessing officer as of today. So therefore, this regime, the notice can come anywhere from all over India. Anywhere from all India. So now, in order to enable centralized issuance of notices in an automated manner, amendment is made to provisions of Section 142(1)(1) to empower prescribed income tax authority besides the assessing officer to issue notice under the said clause. Next. So yeah, this is the inquiry before assessment. Now reduction of timeline for completing assessment. My dear friends, professional colleagues, you know that section 153(1). Time limit for 143 or 144 earlier used to be 24 months, then reduced to 21 months. And then, by Finance Act 17, it was again reduced to 18 months, 143 and 144, 153 subsection 1 is the section where time limit is given for passing order under 143 or 144, further reduced to 18 months for 18 and for by Finance Act 17. Now they are telling because of faceless assessment scheme, assessment procedure has been completely overhauled. Now the assessment procedure is now conducted in a completely faceless and jurisdiction-less way, where all internal and external communication are made electronically, and different aspects of all assessment procedures, like your verification, scrutiny, etc., are carried on by different units. Already, you are facing the music. I went to office today morning, in fact, 7 o'clock. I sat there for an hour. That's 1 hour we opened the office. I drafted 2 appeals and I came back. All faceless assessment order. Assessment order is passed. Show cause notice issued along with draft assessment order. The assessee has taken time. Please give me 7 days time. Even before 7 days are over, they have passed the order. They have made additions. So, this is the way it is faceless assessment. Please go and tick there. My good friend Tarun was discussing. He clicked that video conferencing also. He had that video conferencing. He was there, assessee was there, and the officer was there. So, I have been receiving messages from all over India. Few of the officers are very conferencing and few are highly arrogant. Few of the officers have told very good. They have done that video conferencing. They found him to be friendly. He gave time not more than 20 minutes. So in this case, my good friend Tarun told 20 minutes. I had the time. He discussed it. He was not interrupted at all. The client was also put on unmute. He was not allowed to speak anything because at the beginning he asked whether the CA wants to, present your submission or the client wants to present the submission. It was told, the CA told, no, sir, I only want to, submit on behalf of the client. Fine. He was unmuted and this fellow was allowed 20 minutes. There was no absolutely, no interference from the officer, and he gave his submission. But likely it seems that additions would be made because there was no, much inquiry or much, what do I say? Not many questions were raised, and that's all. He just gave an opportunity. Come online, explain your case, and after 20 minutes, fine. I have taken your submission on record. That's all. So now, what are they telling? I want to reduce. Why? Because of this faceless assessment. So therefore, time limit of the team-based approach, dynamic jurisdiction is technological driven, very efficient. Therefore, the time required for completion of assessment procedure needs to be further reduced. And therefore, I am going to reduce the assessment by still 3 months. So before amendment for 12 months, now only 9 months. So therefore, my dear friend, that income tax return 21-22, 31st March 23, now after amendments, it's only 31st December 22, still reduced. So even scrutiny work you cannot do, sir, after 31st December. You can't file return, you can't file billet return, you can't file revised return. Even scrutiny assessment will be over by 31st December. Similarly, for your regular assessment. I think just last 3 minutes and we can stop. Now, similarly, for existing provisions of 143(1)(a), what is it? Again, intimation time limit is reduced. It was 12 months. It became 9 months now. Again, they reduced 3 months. Again, what have they done? They are telling that I am going to, there were 6 clauses. So they have reduced, they have given this. Yeah. So subclass 4, adjustment on account of increase in income tax, income indicated in audit report, but not taken into account in computing total income. Automatically intimation will be passed to give consequential effect to amendment carried out in section 80C, that is Wide Finance Act 1918. That is chapter 6 under that C. What is that? 80IA, 80AB, etc. 10AA, all this should be filed. Income, all this income related deduction should be filed within the due date specified under 139(1). Else, intimation will be passed and exemption will not be allowed. Deduction will not be allowed. I told you chapter 6A, heading C. Under heading C, all this will be allowed. 10AA is now included only if the return of income is filed on or before due date. Otherwise, automatically return intimation will be passed. Now, quickly we move forward. Yes, IT-80 is on the way, sir, to become a faceless to the extent technologically feasible. It is going to become faceless. faceless assessment, faceless appeals, faceless penalty, and even now ITAT. Now, the most important amendment, according to me, of this year's budget is your 148. Entire 148, 147, 148A is inserted. 148, 147, 151, totally revamped and substituted. What are they telling now? Earlier, what was 4 years and 6 years has now been reduced to only 3 years and 10 years in special cases. What are they telling? 153A, B, C, D, these 4 search sections which came into vogue, which came into the statute from 2003 are now deleted in the statute, sir. They are telling goodbye. 153A, 153B, 153C, 153D. It came in 2003. Now goodbye. These 4 sections are knocked off from the statute. Again, the word reason to believe is removed. What has come in reason to believe? Instead of reason to believe, word information is there. Now they are telling possession of evidence, books of accounts, etc. What are they telling? Earlier, up to 4 years, beyond 6 years. Beyond 6 years, up to 16 years, in case of a resident in India having any asset abroad or having any income from asset abroad, not disclosed. Now that section is deleted. Up to beyond 4 years, beyond 6 years, up to 16 years is deleted. Again, they are telling up to 4 years, beyond 4 years, up to 6 years. It is now only 3 to 3 years and above. But 3 years, very welcome amendment, sir. 3 years, but they are telling it can go up to 10 years. Up to 10 years when? If in the period beyond 3 years up to 10 years, in each of the year, if the income which has escaped concealment, which has undisclosed income, any of the year is more than 50 lakhs. Now they have introduced section 148A. What are they telling? Wait, I will not issue 148. I will do inquiry. I will issue a notice. I will do inquiry. I will find out if income has escaped assessment. Even before you telling me, I myself will give you reason to believe. I myself will give you that recording the reasons, reason to believe, etc. Reason to believe word is removed, but the recording the reasons, I will share the reasons recorded with you only. And I will decide first. Let us discuss whether income has escaped concealment. If the income has escaped concealment, after due inquiry, I will pass an order 148A. Along with 148A, I will issue 148. How beautiful. The GK and dry shaft is now inbuilt in the statute itself. Now they are telling, earlier what was GK and dry shaft. Now they have been inbuilt in the statute in 148A. I will first, suppose it is not required, then I will pass an order 148A telling no need to issue 148 at all. And then for case of search and all, they are not going to give you, sir, 148A, because search, survey, etc. that is deemed to be, for that no reasons they are going to give you. Anyway. And now information, what do you mean by information? They have given the meaning, sir. Information is what? Which is flagged by your computer system. Yes. As well as your audit objections. All this is information. It is given there itself. Yes. Information which has been flagged accordance with the risk management strategy formulated by the board. Everything is computerized, sir. So even that information shall be considered as information which suggests that income chargeable to tax escaped assessment. The flagging would largely be done by computer-based system. Again, final objection raised by SCAG to the effect that assessment in case of assessee has not been in accordance with the provisions of the Act shall also be considered as information which suggests that the income chargeable to tax has escaped assessment. Now, when that 50 lakhs I told you, if the assessing officer has in his possession evidence which reveals that the income escaping assessment, listen carefully, represent in form of asset amounts to or likely to amount to 50 lakhs or more, then only notice can be issued beyond the period of 3 years, but not beyond period of 10 years. So now in this, what is the meaning of asset? They have put an explanation in this Lok Sabha bill, in the amendment made. They have given the meaning of asset, stating land and building, share, securities, etc. They have given the meaning here. Yes, sir. Yeah, land or building, shares, securities, loans and advances, and deposits. I think I have far exceeded my time, I think. So we have tried to cover all the amendments, including all the changes made in finance bill. I thank all members for a very patient hearing. Yes, sir. Yeah, I am ready, sir. If there is time, I am ready to take, no problem.
Please, sir, let's into questions. Manish, help sir with opening the question is.
Where is the chart? Chat. See, the question here is Mukesh Jain is saying, what is the logic behind 194Q TDS on purchase goods when we already have TCS? They realized their mistake, Mukesh. They realized their mistake telling the TCS, and now they realize the mistake and introduce 194Q on purchase of goods. Actually, they want this should have been introduced in place of TCS last year itself. But that mistake was done. Therefore, 194Q has been introduced. Don't worry, in the future years to come, the TCS on purchase of goods will be given a quiet burial. Next question, what are they telling the recent Supreme Court case on applicable TDS on software license? Should you apply TDS and 195 on software license going further? Yes, sir, absolutely. How to download this session for future reference? I think it will be uploaded on the YouTube. And the presentation, I'll be giving you not this presentation. Don't upload this presentation. I've got one more presentation which I'm going to share with the participants. Where else are there, madam, questions? I think not many are there.
Yeah, not many.
Yeah. I could find only these three questions here.
Yes, sir.
Okay, ma'am.
Okay, sir. Okay.
Yeah.
Okay, sir. Thank you. Members, on behalf of Bangalore branch of SIRC of ICA, I take this opportunity to propose formal vote of thanks for today's study circle meet. In spite of hectic schedule, in spite of pandemic situation, all of you have been patient enough to come over and join the sessions. And thank you so much for Naveen Khariwal, sir, for also sparing his valuable time and addressing all of us and giving an excellent presentation. Big applause to you, sir. Thank you so much, sir, on behalf of Bangalore branch once again to you, sir.
Thank you.
Members, I would like to inform you that on 7th of May, we have half-day seminar on charitable or religious trust and institutions from 10 a.m. to 1 p.m. Session will be taken by our past chairman, Shravan Gurutur. I request all of you to kindly take part in it and enhance your knowledge. I request all of you to kindly take care, stay safe, you and your family. Thank you so much. Thank you, sir.
Thank you. Thank you. Bye-bye.